Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18.
The Hang Seng currently trading 0.4% higher. The Taiwanese index too trading with gains of a similar quantum.
You were saying this is probably the biggest deal ever reached.
On daily chart,
recovery in the rural, it has been excellent.
And most of the components right now, they are in the negatives.
In an AI automation world, we need fewer people.
It has been that one-way fall on the Nifty currently.
well, that is the day so far, and it's turning out to be a negative day. 160 odd. The near-term, actually we've broken near-term supports as well. So will the market find, try to build some base around here? We'll talk about why that perhaps is the reason, especially from a futures and options perspective. Lots to talk about here in terms of single stocks as well. This is
the picture across globe is a lot better right now. I mean, look at Asia. Hang Seng closed with a gain of about 0.7%. The Korean market's up nearly 1%. Even in Europe, now that the deal is struck between EU and US, you've got uncertainty. The risk premium associated with the uncertainty is now ebbing. So there is green on the screen. But look at our own markets here. Look at that mid-cap, small-cap index.
But, Rima, that's not been a trajectory of only 1 or 2 days. That's been the story of the last month and a half. And I was looking at precisely this. If you look at the divergence between the S&P 500 and Nifty in just the last 4... Exactly. And, of course, you have the trade optimism in Western markets. And then you have earnings. I mean, solid US earnings, right? Whereas we are dealing with the earnings issues, earnings casualties. Today's name, of course, would be Kotak Mahindra. We'll talk about that. SBI card. Short point is that earnings, barring, of course, there are good sold in asset quality issues. It's a problem. And folks, I don't think we were going in with so much of asset quality concern in this quarter. Everyone was talking about margin compression. Market was prepared for that. But credit cost rising, asset quality becoming an issue, that's one more thing.
to what's lined up here over the next 60 minutes or so before we go any further. And then we'll sort of get to trades, F&O, etc. So the sell-off in Dalal Street, of course, intensifying a little bit. Nifty has failed to defend the crucial 24,700 level. Real estate, metals, private banks, the worst. We had the management with us, sounding quite bullish, actually. So that's something in a bit. IT pack, right? I mean, down just less than 1%. It's already sold off quite a bit. But talk of earnings, which will come later. IndusInd, GAIL, Bharat Electronics are some of those which we will get you previews for. So that's the lineup here as far as the programming is concerned, and the stocks that you will see us discussing. But we want to quickly get to the action. Don't turn a little bit, think about the other side, or not yet?
Good afternoon, Prashant. Not yet is my answer, purely because, look at the market. The market isn't showing any signs of turning around. Barring a few pharma names, I think we test 24,900, and if we break below that, we could even test 24,500, 550 zone. So I still believe that that's a likely outcome. Around this 24,500 odd levels, give and take a few points. A couple of weekly supports kind of taking charts, which I think we are still, a few hundred points away from there. Having said that, on the stock side, I have one buy and one sell call. Dr. Reddy's, and I've talked about Pharma as the positive setup. So Dr. Reddy's is a trading buy for me. Keep a stop below 1265, look for targets of around 550, for targets of around 2420.
Got that. This is going to be a big week globally in terms of earnings. 40% of the S&P 500 report earnings this week. From BEL, Mazgao, IndusInd Bank will be tracked very closely, and GAIL. Gurmeet Chadha, Managing Partner and CIO at Complete Circle, is now with us on the show. Price, what is the advice? Did you hold it in your portfolio?
So, Rima, actually, they gave a very good Q1 update, and the stock ran up actually along with HDFC and Bank Nifty. And then Q1 earnings was a larger than expected dip in NIMs. They were expecting about 20 bips. It came out to almost 30, 35 bips, if my memory serves me right. Also, the credit cost marginally went up, which led to more provisionings also, especially also some time back. So I don't think so. There's a structural any issue there. It's just that the market was expecting it's the positioning which was there, expecting a better set of numbers. But if you see the credit growth, it was about 14%, which is higher than the industry growth than some of the other banks. So I don't see any reasons to be worried. Also, the stock is consolidated for long. Disclaimer: we don't hold Kotak in our portfolio. We have ICICI, HDFC, Federal amongst the private sector banks.
For exactly that, are there any indications from the F&O side, data points, PCR, etc., which gives us a sense one way or the other? Mangalam, take it away.
Well, the indication is more of the other way than one. We aren't likely to see any sort of immediate up move. That's what. But thereafter, once those recoveries were sold into, the bulls have thrown in their towel, and that's exactly what we're seeing on the frontline index. The Nifty Bank, as well as the Midcap index, all of them lower, and the India VIX, which was factoring in complacency over the last two trade towel throwing coming in, because at around midday we had 1,000 stocks advancing. That number has now fallen all the way to 600, and the number of stocks which were declining have crossed past that 2,200 mark as well, telling you that both the red and the green lines are the widest distance that they've been. Now, if you look at the 24,800 put, positions are being unwound out there. The writers out there have been caught on the wrong side, and the open interest out there has come down as well. Importantly, the writing on the 24,800 call, 24,700 call continues unabandoned, and the 24,500 put writers are now finding some call ratio, which was already at the lower end of 0.7, has now come in at 0.6, as call writers have increased their positions and put writers are winding down some of their positions. So now the next important level, if the market fails to hold the 24,500 mark as well, will be the 100-day member enterprises. That's actually outperforming in an otherwise bleak market. Short positions out there are being unwound, so some short covering on that counter. But Laurus Labs and IEX, I'm keeping a very close watch on. Laurus Labs, in all probability, enters F&O ban today. And IEX...
Okay, absolutely. Need to keep an eye out on this one as well. Mangalam, thanks very much. And Laurus, definitely. We'll get the fundamental check on Laurus in just a bit. Stock's done very well after the numbers. Speaking of numbers, quite a few came out today. Growth on the top line and the bottom line. And that's rare in a market like this. But the stock... not doing too much, down about 1% or so. TTK Prestige was a weak set. Decline, top line, bottom line. Not a great quarter for TTK Prestige. Stocks down about 0.5%. But the two stocks that I want to put the spotlight on are from the defense space. Quarter. For Zen Technology, I mean, there's a major decline now. Year-on-year, revenue is down. Margins have compressed 300 basis points. For Paris, there is revenue growth, 11% revenue growth, but there's a margin compression of over 500 basis points. And given the rally, especially since April in many of these stocks, out here, I mean, a lot of people who would have bought these smaller private sector names going beyond the HALs of the world, they would be very confused, saying, should we hold on? This is just a one-quarter aberration? Or does it mean that this is too risky?
You need to understand the lumpiness of the business because it's dependent on government orders and export orders. Zen Technologies, in this case, I think the subsidiary saved them the blushes. Otherwise, the numbers could have been even softer. I think what they have mentioned, and the stock moves like this. When it went down from 2,500 to 1,100, we kept seeing lower circuits of 5%. And then from 1,100 to 1,900 also was 6-7 days of 5%. Okay, but to their credit, they have 23, 24 patents. Because of the emergency procurement by the government, they have 100% market share there. So as more orders come up, they should do well. And they're doing a lot of stuff in the anti-drone system as well. Have about 24 patents, if I'm not wrong, one of the highest any Indian companies have. So you have to live with this volatility. You have to look at and have in the portfolio. So we have Solar, we have Zen, we have Bharat Electronics, and we have small exposure in HAL now. See, India is down to now 29 squadrons. We need like 43. In case tomorrow if we have a 3 waves. So that also gives you some kind of stability and not as much as as lumpy as some of the other businesses are.
Okay, so Solar, BEL, Zen, and a little bit of HAL. That's your defense.
Where we did it, right? We did it on the 15th of May.
It was just after Operation Sindoor, I think.
Yeah, so 15th of May.
Yeah.
And guess what? The Nifty Defense Index, from that point, had a nice... not a very large rally.
Yeah.
We are exactly back at it's like a round trip. We're back at the 15th of May levels. The short point being that I think, and we were making that point back then, that news flow and everything is one thing, but when you're buying stocks, you have to be careful about what you pay. Both are equal in that sense. So I think it's important. Even something like an Idea Forge, I'm surprised. I'm looking at this now because I thought it rallied quite hard. From 360, 370 levels, just had a one-way move to about 650. It's back to 450 you pay. Otherwise, especially when you have this a little bit of a frenzy, momentum, you buy something and then you're stuck. Then you don't know. You're waiting for they probably wait a while for you to sort of get your price. So let's just focus on that a little bit. Stocks up about 5.5%. Let's get the details of the results first with Ekta, who will play out the sound bites.
Well, yes, Laurus Labs, the guidance in the conference call has been quite encouraging post the numbers that came out during market hours on fixed. Gross margins could possibly expand to around 55 to 60% in coming quarters. They did not provide a quantitative top-line guidance for FY26, but they've said that they've laid this. Jefferies as well underperformed, raised the target price to 590, and Kotak Institutional has raised their target price to 555 and have a sell rating on the stock. In fact, let's listen in to what the management had to tell us earlier today.
Our gross margins are over 59% now. Looking at the prospects, what we have, and we estimate the gross margins will remain between 55 to 60%. Primarily because of higher contribution coming from non-ARV. Now, we were able to move towards 500 crores per quarter. And we estimate the run rate looking good. As you are aware, CMO business is bumpy, but for the entire year, we expect the CDMO revenue.
Nearly about 48% now on a year-to-date basis. Your thoughts?
So we continue to hold, Rima. So I've seen 70 to 700, then back to 2 in the entire bull market of 22, 23. Laurus did not participate. And now once, you have molecules getting commercialized, if you see the numbers of export month on month, June was almost 107 million. And now they've also got a big, that is also one trigger for the stock to work and promising employment also. So I think their chemistry skills, their ability in CDMO in terms of late life cycle strategies, Secure Act, if it gets passed and sees some light at the end of the day, I think a lot of our companies can do well. Catalent, Lonza, some of the Chinese companies do $6, $7, $8 billion top line. The largest one in our case does what, 600-700 million, which is Divis. It is a lumpy business, and players like CDMO, defense, you got to size your bets well. Diversify it. Don't go overboard in terms of having 10-15% weight in the portfolio. And have a 4-5 year view in terms of
Indian outsourcing in the 1990s. Well, Indian IT outsourcing, the penetration, the arbitrage was very promising. But now in the age of AI, all that is getting questioned. And TC, even HCL Tech, and I think that news sort of got missed, but HCL Tech also clearly spoke about people and non-people. Facility restructuring, which will play cuts, and they have been for the last 1 or 2 years, but now it's hit closer home. What have you made of all the news flow? And is just this the start? And we are going to see aggressive headcount cuts. And how will the investors react to this?
Midcap IT, especially Persistent, Coforge, maybe KPIT to an extent. In general, now we are hit with an auto slowdown, but maybe with the trade deal with the EU and US, where EU talks of only 2.5% import duty to US, it might be just good news for KPIT and auto of Indian IT services companies. I think we've made this mistake so many times. But AI is a bit of a genie out of the bottle. So we'll see how it goes. But I think we have the ability to pivot and really be ready to contribute towards it. They have the cash balances. There is a relatively low order base. In our case, we are less than 5% in IT services. We have HCL Tech amongst large cap, and we are looking at adding in case we get better price points between Persistent and Coforge.
Okay. Got that. Gurmeet?
Researching I think one space which has been out of favor has been chemicals, underowned, 2-3 years of inventory destocking, price points. So we added JG Chemicals, which is into zinc dioxide, added at around 350 odd levels. So it did do well, and now there's a bit of a retraction happening. We are looking at some tactical plays in refinery space, considering the valuations. A lot of them are now, some of them are like half of replacement cost, or maybe 1/3 of replacement tactical in nature. And, we are, as I said, looking at some more opportunities in the recycling space. That's one space I really like. We call it a circular economy. And I think that's something where the market size is too small. So we are looking at increasing weightage in the...
For joining in and giving us perspective, quite helpful in times like these. We do have to take a very quick break. Market, well, still nursing a cut of about 150 points on the Nifty. Midcap index still down over 400 points. Take a break. We'll get...
Welcome back. The Nifty below 24,700, 150 points gone in the benchmark. Sensex down 550 points. What about individual stocks? Hormus is here to put the spotlight on mid-caps and small caps.
Plenty of movers. In response to that, the stock was down 3%. And today, the stock has seen a 10% knock as well. And that is the biggest single-day fall that the stock has seen since June 2024. And now with this fall, it is moving towards its next 2 months. The stock has corrected 30% from those levels. Another earnings reaction which came out last week and since then has been sulking is DAM Capital. Another 7% knocked off in today's session. It's down 12% in the last 3 sessions. Now already trading to see some value erosion, and since the 17th of July, the stock has gained only once. Northern Arc Capital is the other one. That too has taken a big knock in today's trading session. Another 7% gone today. It's the 5th straight day of Northern Arc Capital comes on lower volumes, which are less than its 20-day average in today's session. On the positive side, though, Cartwright Tech came out with numbers earlier today. The stock saw a bit of a dip and then has seen a one-way move. Wage companies until March of 2023, when it made a low of 350 rupees. The IPO price is 1600, and since those levels, the stock is up almost 6x. And today, it's traded almost 40 lakh shares, almost 5%, down 6 in the last 7 sessions. And the last 3 years, the stock has had negative returns, even you compare in absolute terms. And this is after gaining 90% each in 2021 and 2020.
For that. So that is the unusual movers pack with Hormus as always. Nitin Bhasin is with us, head of institutional equities at Ambit. Nitin, good afternoon. Good to have you with us here. Surabhi was reminding me that you had a bit of a... you were constructive on IT, Nitin?
Yes.
Back in March, you still hold that view after the result season? Maybe too late to sell, but I mean, do you think it'll make money?
On IT hasn't worked out. In the last 1 month, IT sector has underperformed the bank Nifty by about 5 or 6 percentage points. I think clearly that's what the past is, etc. So we believe that if you were to take a little longer view of 3 to 6 months, our view for the midterm for our investors, institutional investors, is from here on, perhaps.
I mean, just elaborate on that call, because earnings estimates anyway, they're so feeble, right? We're talking 0 to best case 3-4% growth. So what is the view? I mean, is it just going to be a play on the cash, maybe allocation? So just elaborate on that. And also the negative view that you have banks, that's turning out to be, absolutely spot on, at least just looking at short-term earnings. I mean, first quarter has been really disappointing, barring HDFC and ICICI Bank.
Highlighting is that we are into the fiscal year in which the flows are reducing because of the last 12 months of Nifty performance or funds performance, because of which and 10%, which is not any different from about 1 quarter back, 9 or 10%. So in a market environment where flows are perhaps reducing, number two, where the earning estimates are very, very frail or feeble or low numbers, where do you increased in concentration, in which profits start becoming concentrated. And hence, the three sectors which have performed in each of those two cycles in the past, when we've had that in 2010 to 13, or let's say between 17 to 20, that could be one of the reasons that we have in saying that where the market moves, perhaps for the next 6 months or 12 months or slightly even longer, we've already seen market move sideways for the last 9-10 months. Where do you go and lose? That was one of the larger thinking behind this call. In the near term, what we said was the IT sector has seen a lot of downward revisions in the last couple of weeks or 3 weeks. And with that behind us, we thought as in September quarter.
So, Nitin, the call is in the second half of the year, things get really tough for the Indian markets. We're in for a correction.
So clearly, I don't know about the market correction. We've seen periods in the past where we have. So what are we looking for? We're looking for flows to pick up in India with a considerable trend, or we're looking for earnings trajectory to actually recover. Clearly today, FY27 earnings may be looking buoyant, but again, FIs have turned sellers in the last 1 week or fortnight. And what we see is pretty much a very unpredictable or not a very secular trend of flows. So hence, where earnings visibility is, at best, high single digits or perhaps higher levels, it could oscillate for the next 6 months to 9 months also.
Speaking of earnings, that's a big top-line miss for BEL. It's a wide miss, almost 600 crores of a miss. The profits are fine. Working with was around 4,800 crores. The company's done, far lesser than that. Though the EBITDA line and the margin line is not too bad. And that explains why the stock perhaps is holding up. In fact, they announced an order for Q2. But anyway, that's BEL and stock is in focus. We'll get you more on the earnings in just a bit. On earnings, Nitin, hearing you out, we started the year with everybody telling us FY25 was bad. We had 5-6% earnings.
That if you look at the last 15 years in India, every time we start the year at about 18-19% earnings growth expectations, and we moderate ourselves down to 11-12%. Perhaps that's the